All right, my guest this right now, let's turn to Myles Zyblock. He joins us now from Philadelphia, and also with me in the studio we have Arthur Steinmetz. Myles Zyblock, what do you make of this? What do you make of this potential negative watch for? I'm not going to listen to 12 people. Treasuries, thank you. What do you think of this potential, this negative move by S&P on U.S. Treasuries, the AAA rating?
Yeah, I was talking with my fixed income team this morning, and apparently this is the first time we've ever been put on negative watch. And, I think S&P on their conference call, and I'm not sure if it's still going on or not, but this gives about a 33% chance to an actual downgrade. So obviously it's a big headline. There's no question about that. But, again, working with my fixed income team, what we found is we looked at all AAA downgrades or countries that have lost their AAA status over time. And 12 months after the event has happened, there hasn't really been much of a move in fixed income markets. I think ultimately what this is really telling D.C. is to get their fiscal house in order. All
right, so it's a wake-up call, right, Arthur Steinmetz? It's Get your house in order, because if you take a look at the biggest mutual fund, we're talking about the PIMCO, Total Return, Bill Gross, he's actually short Treasuries. He's been short Treasuries. That's public news. So why would S&P come out with this kind of news today? I mean, is this really relevant?
Well, I hope the Chinese don't hear about this, about the downgrade.
Yeah.
They might sell Treasuries.
Well, and then they increase the reserves, right? That was a nice little 1-2 punch.
Treasuries are just a touch stronger on the day. There's obviously no new content in this. In my career, I've never reacted to any sort of ratings changes by the rating agencies other than perhaps to sell on an upgrade.
Sell on an upgrade.
So there's really no information content in this. People are certainly well aware of the fiscal challenges that the United States faces and will continue to face. And it is certainly true that ultimately, Treasuries, the safety of U.S. Treasury debt is affected by weak fiscal policy. But what does it mean? It means that down the road, will the Treasury default? No. It does mean that the value of Treasury debt may be inflated away. It does mean that the taxes may have to increase to support entitlements. But there's no new information content in the move today. And again, the markets reflect that.
All right, well, let me bring Myles Zyblock, come in on this topic. And if you can, explain exactly why anybody would give credence to these rating agencies that managed to miss the entire subprime crisis. Why are they now considered experts when it comes to government debt?
That's a great question. I mean, rating agencies, as we know, have a history of being very late to the game. As Art has suggested, today's announcement, maybe the timing is a little of a surprise, but at the same time, I don't think the message is a surprise. I think what the markets are dealing with today is obviously the headline risk coming out from the ratings, or not the ratings change, but the outlook change. But at the same time, over the weekend, we had China tightening, so we still have worries about inflation playing out, global inflation playing out in the background. And obviously, the European, the periphery, the sovereign situation is still a concern. So I think we have these three things coming at us at once, and it's made for some pretty dramatic headlines.
Let me throw something else at you, Myles Zyblock. At RBC Capital Markets, what do you think of oil prices? Oil stocks and crude falling substantially today.
Well, part of that is just the general risk trade has been turned off, especially today. When you have a dollar rally, it tends to put pressure on the commodity complex, and oil selling off in sympathy. And if you look at the CFTC, the speculative long positions on oil, it's a pretty crowded trade here. So, obviously we're covering some of our longs. We're selling down oil and a lot of the commodities at once. And I think that's really what's going on.
Arthur Steinmetz at OppenheimerFunds, you've been writing about predestination. Let me get you started. What does that mean, and why is it important to understand predestination in a market like this?
Yeah. I mean, as it's been said, history doesn't repeat, but it rhymes. And indeed, you can see the shadows of what's to come in the conditions of the markets today. Right now, I'm an old bond guy, so what I like to look at is the shape of the yield curve. And right now, the yield curve is as steep as it gets, 300 basis points nearly between 2-year and 10-year Treasuries. That tells us that the liquidity spigot is on. We know that the Fed's balance sheet is hugely pumped up, and we know that all of that lays the seeds for the end of the cycle down the road. But we have to recognize that right now, liquidity is ample. And so while I certainly
ample, you can swim in it and drown in it.
Exactly. So while markets may react to tape bombs, as we saw today, Chinese tightening, as Myles pointed out, Greek debt or European sovereign risk, all of these, and the S&P, the fiscal situation in the United States, all of this is well understood by markets. Yet, when you, for instance, you look at Treasuries today, which was directly affected by the S&P, well, they're unchanged.
Right, 3.4% for the 10-year.
The stock market is reacting to all of these other things, but we're very careful not to make spastic moves around these things. Even though we know that the music will stop eventually, it's very clear to us what the signals are for that. And the stuff that came across the news, came out on the tape today, isn't that signal. As long as liquidity is ample, the yield curve is steeply sloped, we think that there's reasonable case to be made that asset returns continue to be decent. Valuations are not stretched to our way of thinking. When the yield curve does finally steepen, when the Fed has to remove liquidity, the curve flattens out, then we'll be having a different discussion. But I would say make hay while the sun shines, even though...
And that could be just maybe 60 days, right? Because, I mean, QE2 ending in June?
Well, you look at what happened in Japan at the end of QE2, or their quantitative easing move in 2006. They withdrew $400 billion from the system in 3 months. They collapsed their balance sheet. Well, which is way faster than anything the Fed is talking about doing. And yet, what did JGB yields do over that period? They were flat.
They were flat.
They
Nothing
rose
happened.
in anticipation of that.
But then
as
when it
yields
happened,
are rising
nothing
today.
ended up happening to the yields.
Nothing.
All right.
And so I think markets will well anticipate the ending of QE2 in June.
All right. It worried me a little bit because when you mentioned the music stopping, it just reminds me of that Chuck Prince quote from Citigroup,
Sure.
former chairman of Citigroup, CEO of Citigroup, talking about when the music stops.
I would say don't fight the Fed.
Don't fight the Fed. Myles Zyblock, tell us about the increase. I mean, we know that energy prices are down today, but tell us about the increase in energy prices and what that's going to do to the economy and whether that's going to continue.
Well, my sense here is you don't know exactly at what point or what level energy prices are going to cause a lot of demand destruction and a lot of problems in the economy. I think for that you have to look at leading economic indicators to tell you when the vulnerabilities increase, like the ISM, as an example, dropping below 50. But within the market, the dynamics within the equity market, the dynamics I think are already starting to surface. Obviously, there are some concerns about margin pressures, at least localized margin pressures from energy costs, and that will be exhibited perhaps in some of the retail stocks and maybe in some of the consumer staple stocks in relative terms. They usually tend to get to underperform at least when energy prices are rising.
Do you agree with Myles? Do you believe that this is going to put pressure on margins? And also there was this story about people hijacking tomatoes because the price of produce has increased so much.
Yeah, I would agree completely with Myles. So generally speaking, you'd want to focus more on companies where, transportation costs are a smaller part of their overall input costs, everything else being equal. But so far, the economy has proven reasonably resilient to this, which is a testimony to the lower energy intensity of the U.S. economy. A unit of GDP requires less oil to produce these days.
Does it make it more difficult for lawmakers in Washington to raise taxes if the price of gasoline goes up? Because that's a tax on people who use gasoline. You're not going to get that money anywhere else.
Oh, that's absolutely right. And policymakers ignore the man on the street at their own peril. As we saw, the Fed did some outreach in Brooklyn, and they got skewered for pointing out that the price of iPads hasn't gone up.
Imagine that.
Wasn't making it.
Myles Zyblock, how much does it cost to fill up your car? And do you think that the president is more worried about the price per gallon for gasoline than he is about S&P and the negative watch of U.S. credit?
That hurts at the polls. Obviously, $4 a gallon is becoming more commonplace across the country. My sense is that is definitely political risk. But as the Fed told us the other day, they don't think their policies are stoking the commodity price inflation. So
you're smiling, Myles. So do you believe them, or do you have a different opinion that you'd like to share diplomatically?
Well, the thing is that when you have very low real interest rates and downward pressure on the dollar, you have upward pressure generally on commodities. But I'm not saying that's the only upward pressure on commodities. There's obviously the global growth profile's improved as well. But to say that there's been no impact on commodity prices from Fed's easy policy, I think is just missing the point.
Do you agree with him, Art?
Yes, generally. Yeah. But you also have to say that the Fed is on reasonably firm ground when they say that you know, they focus on core inflation as
Right.
opposed
It's
to headlines.
transitory this time.
Well, it may be.
Maybe.
But
We gotta leave it
take them
there.
at the word that they will react to core inflation.
Arthur Steinmetz from Oppenheimer Funds, Myles Zyblock from RBC Capital Markets. Coming up.